Moving on, oil prices dropped below $80 for the first time in 4 months after the U.S. and Iran hinted at a peace deal this week. But analysts believe the relief may be short-lived as deeper structural issues continue to weigh on energy markets. Market experts indicate that volatility is likely to persist, with oil now carrying a significant geopolitical risk premium even if tensions ease. They suggest that the recent rally and correction in prices do not fully reflect the complexity of the recovery ahead. Analysts point out that global oil inventories have been heavily depleted during the conflict, particularly due to disruptions in the Strait of Hormuz. They expect stockpiles to take time to rebuild and warn that they could fall further before fresh supplies meaningfully enter the market. There's also a growing view that the most difficult phase for oil markets is still ahead. Experts believe that logistical challenges, including potential hazards in key shipping routes, as well as the need to repair and service vessels stranded during the conflict, will delay normalization. Some strategists expect oil prices to remain elevated in the coming months. They argue that current levels may not be sufficient to rebalance supply and demand. They anticipate prices could trend higher as markets adjust to ongoing uncertainties around supply flows. Analysts also caution that even in a best-case scenario where shipping routes reopen quickly, significant inventory losses are already locked in, which could keep upward pressure on prices. And at the same time, they highlight that the economic impact of the conflict is beginning to show, particularly in more vulnerable regions. Overall, while markets have welcomed signs of de-escalation, analysts maintain that the oil shock is far from over and that uncertainty will continue to dominate the outlook.